Friends, thank you for being here today. What if I told you that your retirement fund is now being held hostage by a digital casino chip? That the very thing Wall Street told you to avoid, cryptocurrency, is now the only thing keeping the US government's debt machine running, and that when this house of cards collapses, it won't be the crypto traders who pay the price, it will be you. Let me give you a number that should make your blood run cold. $155 billion. That's how much US Treasury debt is currently held by stablecoin issuers, those companies that create digital dollars backed by real assets. To put this in perspective, if we rank these crypto companies alongside nations, they would be the seventh largest holder of American government debt in the entire world. Think about that for a moment. Tether, a company most Americans have never heard of, now holds more US Treasuries than Germany, more than Australia, more than the United Arab Emirates, more than Canada. This isn't just a curiosity. This is a structural fault line running directly beneath the foundation of the American financial system. You see, we've been sold a comforting narrative. Crypto is fake money, volatile, speculative, something for gamblers and tech bros. Meanwhile, US Treasury bonds are the safe haven, the bedrock of global finance, the ultimate refuge in times of uncertainty. But here's the mathematical reality that should shatter that illusion. The fake money companies are now propping up the real money system. The inmates aren't just running the asylum, they're paying the mortgage. And when this arrangement breaks, not if, but when the scaffolding of the entire edifice comes down, your pension fund, your mortgage rate, your bank's solvency, all of it is now tied to the stability of offshore crypto companies that most regulators can't even touch. This is not speculation. This is not fear mongering. This is the incomprehensible new architecture of American debt, and it's already begun to crack. Now, I know what you're thinking. I don't own Bitcoin. I don't own any cryptocurrency. This doesn't affect me. That's exactly what they're counting on you to believe. That's the money illusion at work. The comfortable assumption that if you're not playing at the casino's collapse can't hurt you. But let me explain why that logic, simple household logic, does not apply here. The US government is currently running a deficit that requires it to sell roughly $2 trillion in new debt every single year. Someone has to buy those bonds. For decades, it was foreign governments, China, Japan, Saudi Arabia. But those buyers have been slowly backing away. China has been quietly reducing its treasury holdings. Japan is dealing with its own crisis. The traditional buyers are vanishing in real time. Enter the stablecoin issuers. These companies, Tether, Circle, and a handful of others, have become the newest, most eager buyers of US government debt. And the Treasury Department has become addicted to their liquidity. Projections show these crypto companies will purchase another $50 billion in treasuries in 2026 alone. The government needs this demand. Without it, who's left to fund the deficit? Who's left to keep interest rates from spiking? This is what I call the big secret of the entire system. The US Treasury cannot afford to regulate crypto out of existence without shooting their own bond market in the foot. The crypto market and the bond market are now joined at the hip. They are two sides of the same coin, and that coin is made of paper. So let me walk you through the mechanism. The black box that connects your 401k to a digital token you've never owned. Think of it like a pawn shop window. Tether displays billions of dollars worth of treasury bonds in that window to prove to the world that every digital dollar they issue is backed by real assets. See, they say, we're legitimate, we're safe. One Tether token equals one real dollar because we have the treasuries to prove it. But here's the glitch in the machine. What happens when everyone wants their money back at once? What happens during a bank run? In a traditional bank, the FDIC steps in. Deposit insurance kicks in. There are circuit breakers, emergency liquidity windows, federal guarantees. But stablecoins have none of that. They are shadow banks, entities that function like banks, hold deposits like banks, create money like instruments like banks, but operate with zero regulation, zero deposit insurance, and zero federal backstop. When the run starts, Tether has to smash that pawn shop window. They have to sell those treasury bonds and they have to sell them immediately to meet redemptions. Not next week, not when market conditions are favorable. Right now, at 3 a.m. on a Sunday morning, if that's when the panic hits. And here's where simple mathematics becomes a nightmare. When you try to sell $50 billion or $100 billion worth of bonds in a matter of hours or days, there aren't enough buyers. The price of those bonds collapses. And when bond prices collapse, yields spike. This is the inverse relationship at the heart of the bond market. Price goes down, yield goes up. Now, why should you care about Treasury yields? Because every other interest rate in the economy is built on top of them. Your mortgage rate is Treasury yield plus a spread. Your auto loan is Treasury yield plus a spread. Corporate bonds are Treasury yield plus a spread. The entire interest rate structure of the American economy sits on top of the Treasury market like a house built on sand. When yields spike suddenly, not because of inflation, not because of Federal Reserve policy, but because crypto companies are liquidating in panic, mortgages become unaffordable overnight. Refinancing vanishes. Banks that hold large portfolios of bonds watch the value of those bonds evaporate. Does this sound familiar? It should. This is exactly what killed Silicon Valley Bank in 2023. But let me take you back further because this pattern has a genesis, a historical precedent that should terrify anyone paying attention. The year was 2008, September 16th to be precise. A money market fund called the Reserve Primary Fund held roughly $785 million in Lehman Brothers commercial paper. When Lehman collapsed, that paper became worthless overnight. The fund broke the buck, meaning its shares, which were supposed to always be worth exactly $1, dropped to 97 cents. Panic spread instantly. If one money market fund could break the buck, couldn't others? Investors rushed to pull their money out of every money market fund they could find. Within 24 hours, there was a run on the entire money market industry, an industry that held $3.8 trillion in assets. The credit markets froze. Companies couldn't roll over their short-term debt. The commercial paper market, the lifeblood of corporate America, dried up completely. The Federal Reserve had to step in with emergency guarantees. They essentially promised to backstop the entire money market industry to stop the panic. It was one of the most dramatic interventions in American financial history, and most people still don't know it happened. Now, here's the terrifying parallel. Stablecoins are the new money market funds, but they're bigger, more interconnected, and completely unregulated. And unlike 2008, when the crisis happened during business hours with federal regulators watching in real time, a stablecoin crisis will happen on the blockchain 24 hours a day, 7 days a week, across every time zone simultaneously. When Tether breaks the buck, when it drops from $1 to 99 cents because redemptions are overwhelming their treasury reserves, the run will be faster and more violent than anything we saw in 2008. There will be no closing bell, no time for the Fed to organize a response, just a cascading liquidation event happening at the speed of digital transactions. And this leads us to the system's most crucial secret, which we must explore further: the political protection racket that's already been built around this risk. You see, friends, what makes this situation truly inescapable is not just the mathematical risk, it's the political architecture that's been constructed to protect it. The call, as they say, is coming from inside the house. Let me introduce you to a name you need to remember, Howard Lutnick. He's the CEO of Cantor Fitzgerald, one of the most powerful bond trading firms on Wall Street. And Cantor Fitzgerald isn't just any firm, they are the custodian of Tether's Treasury holdings. They manage those billions of dollars in government bonds that supposedly back every Tether token in circulation. Now, here's where it gets interesting. Lutnick isn't just a Wall Street power broker. He's become deeply politically connected at the highest levels of government. The merger between crypto money and state power is complete. The very people who are supposed to regulate this risk are now invested in its survival. This isn't conspiracy. This is stated policy. And it brings us to a piece of legislation that passed in 2025 with bipartisan support, a law with an ironic name that perfectly captures the delusion, the Genius Act. The Genius Act was sold to the American public as cryptocurrency regulation. Finally, the government stepping in to bring order to the chaos, to protect consumers, to ensure that stablecoins operate with proper safeguards. But economists who actually read the fine print are sounding the alarm. The law doesn't eliminate the risk, it legitimizes it. It gives stablecoins a regulatory stamp of approval without requiring the kind of capital buffers, stress testing, or federal oversight that actual banks must maintain. In other words, the government just gave a green light to shadow banks to become too big to fail without making them operate by the same rules as traditional banks. It's the worst of both worlds, systemic importance without systemic oversight. And the timing couldn't be more dangerous because we're watching three distinct canaries collapse in the coal mine right now. Three pieces of forensic evidence that the rot is real and spreading. Let me explain this in simple terms. Hedge funds have discovered a beautiful arbitrage opportunity. They borrow stablecoins at very low rates, use those stablecoins to buy treasury bonds, and then capture the spread between what they're paying to borrow and what they're earning on the bonds. It's leverage, pure and simple. They're making money on borrowed money. But here's the linchpin. The entire trade depends on stablecoins maintaining their peg to the dollar. If Tether drops to 99 cents, suddenly that borrowed dollar costs more to pay back than the bond is yielding. The math breaks, the trade unwinds. And when leverage trades unwind, they don't unwind slowly. They unwind in a cascading panic. Every hedge fund running this strategy will try to exit at the same time. They'll all try to sell their treasuries simultaneously. They'll all try to buy stablecoins to repay their loans simultaneously. The market cannot absorb this volume. Yields will spike, prices will crater. And the treasury market, the deepest, most liquid market in the world, the one market that's supposed to be impossible to break, will discover it has a fault line running right through the center. Here's a number that should keep you awake at night. 99% of stablecoin volume is denominated in US dollars, but the vast majority of issuers operate offshore. Tether is based in the British Virgin Islands. Circle has some US operations, but much of their structure is international. They are legally beyond the reach of American regulators. Now think about what this means during a crisis. If Tether collapses, if there's a massive redemption run that forces them into insolvency, the Federal Reserve has no legal authority to seize the assets, to freeze the liquidation, to impose an orderly wind down. The assets are offshore. The company is offshore. And while the chaos unfolds, billions of dollars in Treasury bonds will be dumped onto the market with no coordination, no communication, and no circuit breakers. The Fed learned in 2008 that they could contain a domestic crisis because they had legal jurisdiction. They could force bank mergers, impose lending requirements, seize failing institutions. But an offshore crypto company, they're flying blind, they're powerless, and the Treasury market will take the full impact of that liquidation with no one at the wheel. This might be the most terrifying data point of all. Just two companies, Tether and Circle, control 85% of the entire stablecoin market. There is no diversification, no redundancy, no backup system. If either one of these companies fails, it doesn't just create a problem, it creates a systemic implosion that takes down the entire sector simultaneously. Imagine if 85% of all checking accounts in America were held by just two banks, and neither bank had FDIC insurance, and both banks were based in foreign jurisdictions, and both banks were allowed to operate with leverage ratios that would make a Vegas casino blush. You'd call it insane. You'd demand it be shut down immediately. But because it's happening in crypto, because it's wrapped in the language of innovation and technological progress, we're told to accept it. We're told it's the future. We're told that concerns about systemic risk are just old-fashioned thinking from people who don't understand the blockchain. And that brings me to the trap, the no escape encirclement that should make every American understand why this affects them personally, even if they've never touched cryptocurrency. Let me lay out the two scenarios, and you tell me which one sounds like safety. Scenario one, crypto crashes. Bitcoin falls 50%, Ethereum falls 60%. The entire digital asset space implodes in a wave of deleveraging and panic. What happens next? Millions of people rush to redeem their stablecoins for actual dollars. Tether and Circle are forced to sell their treasury holdings, $50 billion, $70 billion, maybe $100 billion worth, into a market that cannot absorb that volume. Treasury yields spike. The bonds in your pension fund lose 10%, 15%, 20% of their value overnight. Your 401k statement arrives and the number is smaller, much smaller. Meanwhile, mortgage rates jump from 6% to 8% because Treasury yields are the foundation for all other rates. Housing affordability, already terrible, becomes catastrophic. Banks that hold large bond portfolios watch their capital ratios evaporate, and we get another Silicon Valley Bank situation. But this time, it's not one regional bank, it's dozens of institutions simultaneously. Scenario two, crypto booms. Bitcoin goes to $150,000, Ethereum doubles, excitement floods back into the market. What happens next? Stablecoin issuers grow even larger. They buy even more treasury bonds. They become even more systemically important. The concentration risk grows. The offshore black hole expands. And the next time there's a crisis, and there will be a next time, the liquidation is twice as large, the spillover is twice as severe, and the collateral damage to ordinary Americans is twice as devastating. Do you see the trap? Whether crypto goes up or down, the American financial system loses. The architecture is rigged for failure. Your pension, your mortgage, your bank account, all of it is now hostage to the stability of a digital casino chip issued by companies you can't sue, regulators can't control, and the Federal Reserve can't bail out. This is what systemic spillover looks like. This is what happens when fake money becomes too connected to fail. And I need you to understand something critical here. The people running this system know exactly what they're built. They're not naive. They're not caught off guard. They understand the fire sale risk better than anyone. That's the specific economic term, fire sale risk. The danger that forced selling crashes prices far below fundamental value. But here's what they're counting on. They're counting on normalcy bias. They're counting on you believing that tomorrow will look like yesterday. They're counting on the fact that this hasn't happened yet. So most people assume it won't happen at all. Human beings are hardwired to believe in stability. We extrapolate from recent experience. The Treasury market has been stable for decades, so it will remain stable. My pension has recovered from every crisis before, so it will recover from the next one. The government always steps in to prevent disaster, so they'll step in next time too. But mathematical reality doesn't care about your psychological comfort. The structure is unsound, the foundation is crumbling, and the longer we wait, the larger the edifice grows, and the more catastrophic the collapse becomes. The convergence is already here, friends. We are watching three forces hit simultaneously, forces that individually would be concerning, but together create a perfect storm of financial destruction. Force one, a stablecoin market projected to reach $2 trillion in the next few years, buying treasury bonds at an accelerating pace, becoming more systemically critical with every passing month. Force two, a U.S. government desperate for bond buyers, running trillion-dollar deficits as far as the eye can see, increasingly dependent on crypto liquidity to fund its operations. Force three, a shadow banking system with zero FDIC insurance, zero federal oversight, and zero legal accountability, operating 24/7 across global time zones with no circuit breakers and no emergency protocols. These three forces are converging right now, not in some hypothetical future, not in a worst case scenario that might never materialize, right now, already begun, vanishing in real time. So, what do we do with this information, friends? How do we prepare for a crisis that most people don't even know is building? The first step is psychological. You have to recognize the interconnectedness fallacy at work in your own mind. This is the comforting lie we tell ourselves. I don't own crypto, so a crypto crash doesn't affect me. I invest in safe traditional assets, so the digital casino doesn't matter to my portfolio. But that logic is based on a financial system that no longer exists. The walls between crypto and traditional finance have been demolished. Your bank owns treasuries. Your pension fund owns treasuries. Your money market fund owns treasuries. And when the crypto market forces a fire sale of treasuries, when Tether and Circle are liquidating tens of billions of dollars to meet redemptions, you are the one who pays the price in higher interest rates, lower bond values, and vanishing wealth. The money illusion is particularly dangerous here. You might look at your brokerage statement and see the number hasn't changed. Your 401k still shows the same balance. Your bond fund still displays the same share price. But that's yesterday's number. That's the price before the liquidation. That's the value in a world where treasury markets are stable and predictable. When the stablecoin crisis hits, and it will hit because mathematical inevitabilities always arrive eventually, those numbers will change. You'll become a millionaire on paper, in nominal terms perhaps, as inflation erodes the currency. But you'll be poorer at the grocery store, poorer at the gas pump, poorer in every way that actually matters to your daily life. And here's what makes this particularly insidious. The crisis won't announce itself with headlines and emergency broadcasts. It will start at 3 a.m. on a Sunday morning when Asian markets are open and American regulators are asleep. You'll wake up Monday morning, check the financial news, and see a bland headline: Treasury yields rise on market volatility. That's not market volatility. That's not economic news. That's a crypto liquidation event. That's Tether selling $20 billion in bonds because redemptions are overwhelming their reserves. But the financial media won't tell you that because they either don't understand the mechanism or they're invested in maintaining the illusion of stability. So let me give you a concrete action step, something you can monitor yourself to see this crisis developing in real time. Watch the 2-year Treasury yield, not the 10-year, not the 30-year, the 2-year. That's where stablecoin issuers concentrate their holdings because they need liquidity. They need to be able to sell quickly if redemptions spike. The 2-year Treasury market is ground zero for stablecoin liquidation risk. If you see the 2-year yield jump 20 or 30 basis points in a single session, especially during off hours, especially on a weekend, especially with no corresponding economic news, that's your signal. That's the structure beginning to crack. That's the foundation giving way. And when you see that signal, understand what it means. The largest forced liquidation in Treasury market history is underway, and your pension fund is about to take the hit. Now, I can already hear the objections forming in your mind. Surely the government won't let this happen. Surely the Federal Reserve will step in. Surely there are adults in the room who will prevent this disaster. And that brings me to the most uncomfortable truth of all. The government cannot fix this without destroying the very thing they're trying to save. Think about the options available to policymakers. Option 1, regulate stablecoins out of existence, shut them down, force them to operate like real banks with real capital requirements and real oversight. But if you do that, you lose the $50 billion per year in Treasury demand they're providing. You lose the biggest new buyer in the bond market at exactly the moment when traditional buyers are walking away. Treasury yields spike anyway, not from a crisis, but from lack of demand. The deficit becomes unfundable. The entire debt machine seizes up. Option 2, bail them out when the crisis hits. Extend Federal Reserve emergency lending to Tether and Circle. Guarantee their deposits like you would for a traditional bank. But these are offshore entities. The legal authority doesn't exist. And even if you could somehow create it, you'd be asking American taxpayers to backstop a Cayman Islands crypto company that operates with no oversight and distributes profits to anonymous token holders around the world. The political backlash would be apocalyptic. Option 3, do nothing. Let the market work. Let Tether fail if it can't meet redemptions. Let Circle collapse if they're over-leveraged. Let the Treasury liquidation happen and let yields find their natural level. But this isn't a theoretical exercise in free market economics. This is a $100 billion fire sale hitting the most important financial market in the world with no warning and no preparation. The collateral damage would dwarf the 2008 crisis. Do you see the trap? Every option available to policymakers makes things worse. The architecture is rigged for failure because the foundation was never sound to begin with. We built a system where shadow banks fund sovereign debt, where digital casino chips back pension funds, where offshore entities control interest rates for American families. And the people who built this system, the Howard Lutnicks of the world, the politicians who passed the Genius Act, the regulators who look the other way, they will be fine. They have their wealth in hard assets. They have their connections and their golden parachutes. They'll land on their feet. But you, the teacher with a 403B, the factory worker with a pension, the young couple trying to save for a house while mortgage rates spiral out of control, you're the ones who will pay the price for this incomprehensible architecture of risk. So let me be very clear about what I'm advocating here. This is not financial advice. I'm not a licensed advisor, and you should make your own decisions based on your own circumstances and research. but I am going to share what I see as the only rational response to a system this fundamentally broken. The choice in front of you is binary. Do you own assets or do you own claims on assets? Let me explain the difference. When you own a stock, you own a claim on a company's future earnings. When you own a bond, you own a claim on a borrower's promise to repay. When you own a dollar in a bank account, you own a claim on the bank's promise to give you physical currency on demand. Claims, 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 paper promises stacked on top of paper promises. But when you own physical gold, you own an asset, not a claim, not a promise, an asset that has held value for 5,000 years. Through every currency collapse, every sovereign default, every financial crisis in human history, an asset with no counterparty risk, meaning its value doesn't depend on someone else keeping their promise. When you own physical silver, you own an asset that industrial civilization cannot function without. Solar panels, electronics, medical equipment, water purification, all of it requires silver. And while paper claims on silver can be created infinitely through derivatives and futures contracts, physical silver is finite. It comes out of the ground at a fixed rate, and that rate is declining. This is not speculation. This is not a get-rich-quick scheme. This is stepping out of the line of fire. Because here's what happens when the stablecoin crisis hits. Your bond fund loses value because treasury prices crash. Your stock portfolio loses value because higher interest rates make equities less attractive and credit tighter. Your cash loses purchasing power because the Fed will eventually print to contain the crisis, just like they did in 2008, just like they did in 2020, just like they always do. But gold doesn't crash because Tether liquidated treasuries. Silver doesn't lose value because hedge funds unwound their basis trades. Physical metals sit outside the architecture of paper promises. They're not part of the machine. And when the machine breaks down, when the gears seize and the scaffolding collapses, the things outside the machine are the only things left standing. I'm not telling you to put your entire net worth into precious metals. I'm not telling you to panic. I'm telling you to recognize the structural reality in front of you and to position some portion of your wealth, whatever portion lets you sleep at night, outside the system that's rigged for failure. History favors the prepared, friends, and the window for preparation is closing. The convergence I described earlier, the $2 trillion stablecoin market, the desperate government, the shadow banking system, this convergence is not theoretical anymore. It's here. It's operational. It's growing more dangerous with every passing day. You can choose to believe that somehow, magically, this will all work out, that the smart people in charge have a plan, that the system is more resilient than it appears. That's your right. That's normalcy bias speaking, and it's a powerful force. Or you can choose to look at the mathematical reality, the incomprehensible scale, the offshore risk, the concentration, the leverage, the interconnectedness, and recognize that this edifice was never designed to stand. It was designed to profit a small group of insiders while the music was playing. And when the music stops, when the liquidity tide goes out, we're going to find out who's swimming naked. I'll leave you with this final thought. In every financial crisis, there are two groups of people: those who saw it coming and prepared, and those who didn't. The first group protects their wealth and sometimes even profits. The second group wakes up one morning to find that the numbers on their statements have changed, that the promises they relied on were made of paper, and that the safety they assumed was an illusion. Which group will you be in when Tether breaks the buck? Friends, thank you for being here today. Stay vigilant, stay prepared, and remember, the structural fault line is already cracking. The only question is whether you'll be ready when it finally breaks.